Hi, everyone. It's John. Welcome back. This is a GMU Extra. We're going to explore shakeouts, or should you be getting out? So in this mini presentation, we're going to look at what is a shakeout, how institutions create them, what to look for if it's an opportunity, or the characteristics where you should really avoid them and get out. Now, shakeouts are violent drops that catch a lot of the weak holders and get them knocked out of a stock, and they reverse back up very, very sharply and quickly. So shakeouts can scare you out based on the price action, or sometimes they take time and they wear you out. Weekly shakeouts can be more meaningful than daily shakeouts, but we want to look for both. Now, most big stocks, big winning stocks, will have a few shakeouts along the trend over the course of a 12 to 18-month move. Now, mysteriously, these shakeouts occur. They're very hard to understand at times, and they definitely can be very, very frustrating on your mental capital if you get shaked out of a position that you enjoy. The typical characteristics, there's usually a couple of wide range bars that occur. A stock might close 40% or more off of its lows, showing that there actually is support for the stock. They're usually associated with very big volume. It can look very, very bad on the sharp decline. And they can be scary looking. They undercut an obvious level of support, and most shakeouts that are successful have a very distinct V shape, and we'll talk about that in some examples. Now, shakeout or pullback, it's difficult in real time to know if something is a shakeout or if it's some sort of normal pullback. Pullbacks generally are orderly declines that are very gradual into a moving average or even to the lows of a base. There's generally no undercut with pullbacks of the previous lows, where shakeouts can be much more sharp, violent declines. And there's undercuts of support areas shaking out people, and they usually have very quick recoveries. We pay attention to those, particularly if we get knocked out. We may have to have the courage to get back into the stock. Now, institutions and retail traders use different tools. Now, retail traders use technical analysis, where institutions are using valuations of stocks. Retail traders are very small in size, so they can get in and out of the market very quickly, like a little speedboat, where institutions have very big size, big footprints, and they're really like a slow-moving tanker. The retail trader will use the simple 50-day moving average, where institutions will use the 65-day. Retail uses the 200-day simple, where the institutional trader will use the 100-day moving average. So the retail traders are really the caboose on the train. They follow the engine. They try to hop on board and get into a trend, where the institutions are the actual engine. They drive the market. They drive the stock price. So a shakeout essentially becomes a situation of accumulation for institutions. They're looking to buy more stock. So let's look at an example. If an institution wants to own 225,000 more shares than they currently have, but they don't want to push the price up above $48 per share. So in order to do that, an institution is going to have to manipulate the retail crowd traders. And how do they do that? So in this example, let's pretend that a stock is in a short trading range, or maybe it's a long trading range, between $45 per share as the support level and $55 as the resistance level. So as these support and resistance levels are established in a consolidation, no one believes the price will go below the support level. That's why it's called support. Now, let's assume in our example that this institution already owns 125,000 shares, and they have it at $48 per share. So I've drawn that line. They own shares at this dotted line as their average cost, but they want another 100,000 shares. Now we know if this is a support range, many, many retail traders will put their stop loss orders just below the support of this consolidation. Some people might put it 1% below the support level, 2%, 3%, 5%, but there tends to be a cluster of stop loss orders that are at the low end of the range. In this case, the example, let's assume that the retail orders all totaled up are 100,000 shares of the stock. So what this institution will do is this institution will purposely sell all of their 125,000 shares. They will dump them on the market in order to force the price down through the support. And that'll bring even more sellers into the market. If you're looking to short the market on the break of this support, you're going to start initiating your short position because you believe the stock is going to go lower. Now, in addition to the short sellers, all of these stop orders are now triggered and become even more selling in the market. So you kind of have a funnel of selling, which is the institutional selling, the retail order selling, as well as short sellers who are hoping to make a buck. Now, what happens is the stock comes down, the same institution that did the selling will immediately start to buy back their original shares. The institution will buy back all of their 125,000 original shares, and they'll grab all of those 100,000 shares of the retail traders. And by pushing the stock to quickly come back up through that support level, all the short sellers, or many short sellers, will have to cover because we've got this surge in buying and the short sellers are on the wrong side. So all of that will be gobbled up by the institution. By doing that, like magic, the institution now has accumulated 225,000 shares, and they've done it at an average cost below $48 a share. That's how a shakeout works in the mechanics. So let's look at some examples. Now, as a template, what we're looking for in a shakeout, we're trying to understand if there really is a accumulation going on or it's really distribution in the stock. Shakeouts that have a V shape, as I've shown here, quick decline, quick recovery is what we're looking for. Very sharp V. Usually it's not a shakeout if the stock sharply breaks, can only have a weak rally, and then rolls over and doesn't go anywhere, and it retests the previous lows. That would not be a shakeout. That would be more of distribution in the stock. So here it is on a chart. Short consolidation, sharp break lower down to the 50-day, and you can see the very quick recovery and the V shape that we're looking for, confirming it probably is a shakeout where the shares are being accumulated. And here's an example of a failure. Sharp decline below the 50, but you can see it never really rallied above the previous peak, and it rolled back and it came back down. Distribution actually is going in the stock, and it's not a shakeout. So here's an example using Smartsheet from a few years ago of a shakeout at the lows of a base. Stock was trying to form a base, and you can see the institutions drove the stock down below the 50-day moving average, breaking some of these prior lows, and quickly brought the stock back up as they accumulated all those shares. And the stock went on to break out of the base. You'll notice that the volume profile is above average volume on the decline, but even bigger volume on the recovery, which is showing you they sucked up all the shares that were available by creating the break. Here's a more recent one in April of 2023 with Rambus. This is a shakeout at the 50-day moving average. The stock had been in an uptrend, and you can see here the sharp sell-off, breaking the red 50-day moving average line with large volume. It doesn't look good here at all. Looks like the stock is breaking down. But within a couple of days, we get that sharp V look, and you'll see that the stock recovers very, very quickly. And you'll notice again the clue. The volume on the recovery is much bigger than the initial sell-off volume. So that's a clue that maybe a shakeout is occurring. Now, in this case, there's a couple of buy points. If you are really aggressive, you may be buying in here as it clears this short-term peak. But the proper way to have more confirmation is to wait for the stock to clear the ultimate peak prior. This is a much more safe buy. This is an aggressive buy, depending on your nature. Now, here's an example of Shift 4 payments from April. This stock also made a very, very sharp decline below the 50-day moving average on very, very large volume, huge red volume. You can look at the shape of this recovery. It starts to form a V, which is we want to see, but the V is lacking a number of things. One, we barely get above the 50. The 50 actually starts to act as resistance, and the stock immediately starts to roll back, never coming close to its prior peak. We want to see the shakeout continue through the peak. So when it rolls over, that's a very bad sign. And you'll notice also that there was no volume on the recovery rally. These days that are blue, there's just no volume. The red volume is standing tall, and there's no blue volume to counteract that. So this is really not a shakeout. And as soon as you know that, right in here is where you should be getting out of the stock if you are caught in the shakeout attempt. Definitely, this is a place you'd get out. Here's a third one. This is Duolingo from May of this year. Again, this is using the 50-day moving average. Very, very sharp pullback into the 50-day. It looks really ugly. The volume's picking up. The price action's terrible. So it's really, really concerning that this stock is breaking down. But you can see very, very quickly the stock reverses its course and gets 1, 2, 3, 4 blue days in a row. The volume comes back, and the break to push back through the prior highs is on the bigger volume than we had on the sell-off. That's a clue that this was a shakeout, and you should have it back on your watch list. In this case, though, if you bought here, it's never very easy. They tested you by coming back and touching the 10-day moving average. So positioning is important. But the important thing is when you get all these pieces, the V, the volume, and breaking out of the high, it's telling you that there's really accumulation still going on in the stock by the institutions. So as a summary, shakeout or get out, we're looking at these quick violent drops and reversals up. Look for that quick short V to form, but also insist that you see the big volume on the recovery, and look at the weekly charts as well as daily. If you get these on the weekly charts, it could be a 1 week bar closing off the lows. You can get these shakeouts at the 50-day moving average, the 20-day moving average, any support and resistance levels when you're in a base, and many times you'll have a base breakout. And after the base breakout, the stock will pull back in sharply and shake out just below the pivot before potentially moving higher. We talked about the characteristics for a weekly shakeout. Wide range bar, look for that bar that closes 40% or more off the lows. Look for the big volume support. It's probably an undercut of some obvious support level on the chart. And insist that you get the V shape. If you get a really slow, gradual U-shaped recovery, that's really typical of distribution in the stock, not accumulation. So thanks for joining me for this GMU Extra. Hopefully you learned a little bit more about shakeouts or whether you should be getting out.